Hi, this is Faisal Haroon. In this video, we will go over how you can take advantage of my tactical asset allocation strategies, as well as how to analyze them to find out which ones work the best for you. First, the legal disclaimer. This video is for informational purposes only. Please trade at your own risk with the money you're willing to lose. Please ensure that you agree with the terms of service at the link shown on the screen. If you continue to watch, it will be assumed that you agree. You can view the list of strategies currently offered at fintech.zehnlabs.com. Each strategy shows some basic performance metrics as well as the pricing. For each strategy, you will see linked to two different kinds of reports. A strategy metrics report that gives you details about what assets the given strategy trades, generally how often the rebalances occur, and other metrics around the execution and management of that strategy. Then we have a performance report that tells us within our analysis period how the strategy performed, including returns, drawdowns, and other essential performance metrics. Even though all strategies listed on our website meet my standards to where I am trading them live, it is essential that you learn how to read these reports and decide which strategies you want to trade. But don't worry, by the end of this video, you should be able to read these reports quite easily. So let's pick a strategy and first look at its performance report. We are looking at a strategy performance report for ETF Blend 102-25. These reports are updated regularly, generally on a daily basis. A side note, in addition to the term performance reports, I sometimes also refer to them as quant-stats reports. The reason for this is because these reports are generated using a Python package known as quant-stats. This is a very popular performance analysis package in the financial technology domain, aka fintech. So as you can see, the name of the strategy as well as the analysis period are displayed across the top. In this case, the analysis period is June 26th, 2015 through April 17th, 2025. The very first thing that I pay attention to is the cumulative returns graph, also known as the equity curve. Here the blue line represents how the strategy performed during our analysis period, while the yellow shows the performance of SPY or S&P 500 during the same period. The key thing that I am looking for in an equity curve is whether it's in an incline from bottom left to the top right. Since the equity curve of this particular strategy is in such a steep incline, it is hard to see SPY's performance during that period. To solve this problem, there is another figure right below it which displays the same graph, but it's log scaled. Here you get to see the performance graph of SPY a bit more clearly. The next thing that I pay attention to is CAGR, which stands for Compound Annual Growth Rate. In this case, we see that it's a bit over 61%. So over the span of the analysis period, this strategy yielded about 61% annualized. It is important to understand that this is an annualized number. It does not mean that every single year this strategy went up by 61%. In the left column, you see that during the same period, SPY's CAGR was about 12%. The very next thing that I pay attention to is the max drawdown. This number is the maximum peak to trough loss that this strategy took within the analysis period. I make sure that this is a reasonable number and within my risk tolerance. In this case, this number is about 11%. If this number was 30% or greater, I most certainly would not trade this strategy. In the left column, you see SPY's max drawdown during the same period was about 34%. This is why I do not like buy and hold, because most of us do not have the staying power beyond 20 or 25%. You have to imagine that when these big drawdowns are taking place, there is a lot of negative sentiment in the media and anyone that you talk to. I have traded multiple such crashes, and people are generally very fearful and very pessimistic. It's pretty natural to get influenced by such rhetoric, especially when we are experiencing a significant drawdown in our own portfolios and exit the market at the worst of times. Therefore, one has to be very comfortable with the max drawdown of any strategy that they choose to trade. If you think that a 10-11% drawdown will be too much for you, simply do not trade this strategy. Another note on drawdowns is that this is not an absolute number. This is the max that this strategy observed during the analysis period, which should give you some idea about how this strategy may perform in the future. Then I look at the Sharpe ratio. So this strategy's CAGR is 61%. Imagine another strategy that has a CAGR of 90%. Is that automatically a better strategy? Not necessarily. Depending on how much we are risking to make that 90%, that strategy might be completely untradeable. The Sharpe ratio measures the excess returns of the strategy per unit of risk. Higher values indicate better risk-adjusted performance. In this case, we see that the Sharpe is a tad over 2. My rule of thumb is that if this ratio is below 1, I simply do not trade it. Also, when I have to choose between strategies to deploy my capital to, I pay close attention to Sharpe and Sortino ratios. More on Sortino in a bit, but the higher this number, the better the potential risk-adjusted return of the strategy. The way that the Sharpe ratio is calculated is by measuring volatility versus returns for every single return of a given strategy during the analysis period. In layman's terms, volatility is the distance of a given return from a mean. However, volatility can be positive or negative. In other words, if I am making outsized returns, do I really care about how far away my returns are compared to a mean? No, I really don't. I do like high volatility when I am making money, but I don't like it when I am losing money. In other words, I like positive volatility but want to avoid negative volatility. This is where the Sortino ratio steps in. It is calculated exactly like the Sharpe in order to measure risk-adjusted returns, but it ignores the upside volatility because normally it doesn't concern us. In our example, we see that our strategy's Sortino is 5.6 as compared to SPY's Sortino of about 1. For me, the same rule of thumb applies. If Sortino is below 1, I do not trade that strategy regardless of the returns, but when it's above 1, I use it to compare different strategies to see which one gives me a better bang for the buck. I also pay attention to the Kalmar ratio, which measures the return of a strategy relative to its maximum drawdown risk, showing return per unit of max drawdown. The idea is the same. You're trying to measure risk-adjusted returns. A higher Kalmar ratio indicates better risk-adjusted performance with respect to large drawdowns. This is particularly useful for evaluating a strategy's worst-case scenarios within the analysis period. I use this ratio to compare strategies and see which ones give me more return per unit of max drawdown. Then I look at the longest drawdown days. In this case, as you can see, the max number of days that this strategy was in a drawdown during the analysis period was 177 days, versus SPY during the same period had the longest drawdown period of over 700 days. Of course, when comparing strategies, I want this number to be as small as possible and also to be within my risk tolerance. Next, I scroll down to the worst 10 drawdowns table and take a look at how much the drawdown was and how quickly it recovered. This gives me a good ballpark idea of how this strategy moves. While I am looking at the worst 10 drawdowns table, I also peek at the end of year returns table to see how much money this strategy made or lost for each year of the analysis period. One thing to note about this table is that since most of the time the analysis period does not start on January 1st, the first year you see in this table will be based on partial data for that year. The same applies to the current year stats. Unless we are very close to the end of the current year, the last row of this table may not be indicative of this strategy's performance year over year. In the same part of the screen, I glance at beta, alpha, correlation, and the train-over ratio. Beta measures the volatility of a strategy relative to the benchmark. This indicates what is known as the systematic risk or market risk. For example, a beta of 1.2 means the strategy is 20% more volatile than the benchmark. Similarly, a beta of 0.8 means that it's 20% less volatile. In our case, the beta is about 0.2, which is very good in the context of its annualized returns and drawdowns. What this tells us is that this strategy makes money while not being too volatile. Alpha is the excess return of a strategy over what would be predicted by beta, the systematic risk, or the market risk. A positive alpha indicates that the strategy outperformed its benchmark on a risk-adjusted basis. As a side note, all the metrics that we are looking at must be analyzed in the given context. For example, a strategy with beta of 0.2 and an alpha of 0.5 means nothing until I also know its CAGR. CAGR by itself doesn't tell me anything useful unless I can understand what I am risking in order to make that return. Moreover, I also have to understand how these numbers compare to the benchmark. So continuing on, correlation measures the degree to which a strategy's returns move in relation to the benchmark. In other words, how much of the strategy's returns can be explained by moves in the benchmark. There is not necessarily a good or bad correlation number, depending upon how you are constructing your portfolio, for example, with multiple strategies or partial allocation of your assets into these strategies and the rest in static or strategic allocation strategies. This number could be useful to understand. Trainor ratio measures excess return per unit of beta, showing how much return a strategy generates for each unit of systematic risk. Since I have already analyzed my risk-adjusted return through other metrics, I do glance at this number, but it hardly ever plays any role in my decisions about a given strategy. Next, I scroll up to look at how the strategy has been performing recently and compare its returns to the benchmark SPY. I look at month to date, 3-month, 6-month, year to date, 1 year, 3-year, and 5-year returns to make sure that the strategy has performed well in more recent times. A strategy could have great metrics for the last several years, but if it's struggling in the recent times, I may not deploy my capital to it right away, but definitely keep it on my short list to see if it starts to perform better in the future. While I am in this section of the screen, I also glance at best day, worst day, best month, worst month, and best year, worst year numbers to get a general idea and to make sure that these numbers do not exceed my risk tolerance. I do pay close attention to recovery factor and ulcer index. The higher the recovery factor, the quicker the recovery from drawdowns. Also, the smaller the ulcer index, the shorter and or shallower the drawdowns. There are no absolute good or bad numbers for these metrics. I generally only compare them to the benchmark or use them to decide about which strategies I should deploy more capital to. A lot of what I explained in this video using the tabular data on the right-hand side of the report can also be quickly glanced at from the visualizations shown on the left-hand side of the report. Visualizations are great for quickly glancing at a given strategy's performance, but they sometimes hide the underlying data that is more visible in the tables. I use visualizations initially to get an overall picture, but then make sure to read the data in the tables before making my investment decisions. We already covered earlier two of the graphs that I look at. The one that I also look at is the end-of-year returns graph. Here, my main concern is to make sure that the blue strategy bars are generally higher than the yellow benchmark bars. This visualization also quickly tells me whether there are any outliers that might be inflating the strategy's CAGR. In our case, we can see that this strategy was over 250% up in 2020. This tells me that I can reasonably expect this strategy to do very well in market crashes, resembling the one in 2020, where a lot of people lost a lot of money. However, it also tells me that the 60% CAGR may not be realistic to achieve in the future years unless there is another crash of the same kind. Then I compare each blue bar in relation to the accompanying yellow bar to get an idea of how this strategy performs in relation to the benchmark. And of course, I also make sure that number of blue bars below 0 are minimum. Then the distribution of monthly returns bar chart quickly tells me that most of this strategy's monthly returns are perhaps in the range of 3 to 4%, and there are outliers which can be 20% or more. The key thing that I look for in this chart is how tall the blue bar is, left of the 0% line, to give me an idea as to how many months during the analysis period this strategy had negative returns. Then moving on to the daily active returns graph, I make sure that majority of the blueprints are above the 0% line, and that the ones that are below that line are generally shorter than those above the line. This gives me the assurance that over the long term, this strategy can be expected to make more money than it loses. Scrolling down to the rolling 6-month Sharpe and Sortino graphs, I make sure that generally the blue lines stay above 1. Of course, the higher the risk-adjusted returns that these lines represent, the better. Next, I spend some time looking at the underwater plot. This gives me an idea of this strategy's drawdowns as well as their recovery period. I want to make sure that the height of the blue lines does not cross a reasonable number beyond my risk tolerance, and that the light blue areas representing the length of recovery period are generally not very wide. These are pretty much all the things that I look at in the performance report. We have also created a very good glossary of most commonly used metrics in these reports. You can scroll down to the bottom of these reports at any time to find a link to our glossary. Next, we'll look at the metrics report for the same strategy. This report tells us which ETFs the strategy trades, generally how often the rebalance events occur, and other metrics we can use to make informed decisions about a given strategy. In the first box in the top left corner, we see the name of the strategy and the analysis period. The middle box in the first row shows the total number of symbols in the portfolio that this strategy trades, the minimum, maximum, and the average number of symbols held concurrently, as well as the 80th percentile of concurrently held symbols. This gives us a general sense of what to expect from the trade management perspective. Then the last box in the top row shows how many rebalance events occurred during the analysis period. Please keep in mind that since these are tactical asset allocation strategies, when the market changes, these strategies rebalance in order to enhance profits or limit drawdowns. It is important to understand how frequently a strategy generally rebalances in order to make sure that you can commit to that much time in executing trades in your portfolio. Then the first box in the second row shows portfolio concentration metrics. You can read the descriptions of these in the report, but they are aimed to show the complexity of rebalancing. These metrics are nice to have a look at, but our service tries to make it simple for you to rebalance your portfolio when needed by providing the tools necessary to do so. The rebalancing by day of week chart shows how many rebalance events occurred on each day of the week during the analysis period. On the next row, you see which assets were most frequently and least frequently held, along with their respective allocations. The portfolio composition box shows all the symbols that this strategy trades. Finally, the correlation matrix shows the level of correlation between different strategies we offer. This is important when you are trading multiple strategies. In such cases, it is preferable to trade strategies that are least correlated in order to get the benefit of diversification at the strategy level. This ends our strategy analysis section. All the strategies you see on our website are already very good tactical asset allocation strategies, but I strongly recommend that you go through this analysis on your own and pick the strategies that you like the best before signing up. The sign-up process is very simple. Make sure that you have the Telegram app installed on your device and your account is set up. Then once you have decided on a strategy to subscribe to, simply click on the subscribe button and follow the simple subscription process. Once your payment has been processed, you will receive a personalized, time-sensitive invitation link to a private Telegram channel. Join the channel to receive timely rebalance alerts with the latest allocation updates for your selected strategy. There is no long-term commitment. You can cancel your subscription at any time. Also, if you change your mind after you have subscribed to a particular strategy, you can switch to a different one easily. We have a very simple getting started guide on our homepage that I recommend that you go through, and we also have a very comprehensive FAQ that I strongly recommend that you read before taking the next step. If you have any questions or concerns, please do not hesitate to get in touch with me. I really appreciate your time in going through this video. I wish you the best of luck in your investment journey and hope that our service will really be beneficial in helping you achieve your investment goals.